Have you ever wondered why your savings account isn't growing as fast as you thought it would? I wonder if that's because you're looking at the wrong numbers. Banks love to show off their interest rates, but what really matters is the AER. The annual equivalent rate. In this video, I'm going to break down what AER actually is, why it's important, and how you can make sure you're getting the most out of your savings. Let's go. But just before delving in, I want to tell you something. 88% of people who watch my videos are not subscribers. To reach more people and to help them in their quest to become better with their money, can I ask you, if you're not already a subscriber, to hit the subscribe button? It would really help me and the channel out. Thanks for doing that. Now back to the video. Let's start with the basics. AER stands for annual equivalent rate. It's a way of showing the real rate of return on your savings, taking into account the effects of compounding over a year. For example, if a bank offers 5% AER, then that means that your money will earn the equivalent of 5% interest over the course of the year, regardless of whether your money is paid quarterly, monthly, or annually. The reason this is important is it allows you to compare different accounts and different savings rates on an apples versus apples basis, regardless of how often the interest is actually added to your balance. But here's the catch. Many banks offer high interest rates and show that they offer high interest rates, but they sometimes don't include the effect of compounding. Or worse still, they focus on short-term promotional rates to suck you in. Here's why AER is important. AER provides a level of transparency. AER tells you the real growth rate of your money, so you're not misled by flashy ads boasting high monthly rates. It highlights the power of compounding. If you leave your money in an account, the interest you earn starts earning interest too, and AER accounts for that. Let's take an example. A savings account paying 0.4% monthly might sound better than a similar account paying 5% annually. But when you look at the AER, you'll see that the second one outperforms the first. Confused? Let me show this in a bit more detail. Initially, 0.4% monthly sounds great. 0.4 times 12 is 4.8. Close enough to 5%, right? And you think the money's coming through to you monthly, so you might be able to use it as well. But let's see what happens in reality. The account paying 5% AER, let's call that account A. If you deposit £10,000 in this account, you'll earn exactly 5% over the year, bringing your balance to £10,500. Let's take the other one and let's call this account B. This one pays 0.4% interest monthly. Instead of simple interest, this account compounds every month. In month 1, you earn 0.4% on £10,000, giving you £10,040. In month 2, you earn 0.4% on the new balance of £10,040, giving you just over £10,080. By the end of the year, instead of £10,480, which you might expect from 0.4 times 12, your balance actually grows to £10,488. So at first glance, the 0.4% monthly, and it might have seemed to you that it was roughly equivalent to the 5% AER. But after a year, it left you with £12 less than account A. Okay, so if you've got £10,000, £12 over a year might not really affect you. But the point here is knowing what the AER is, so you're comparing apples with apples. And don't forget, the difference grows bigger with larger balances and over longer periods of time. The lesson here is that AER already factors in compounding and gives you a true comparison, so you don't get tricked by misleading rates. Always check the AER before choosing a savings account. And if in doubt, ask. Now here are some common traps to avoid. Banks are clever. They often lure customers in with clever marketing tactics. Here's some of them. Teaser rates, a high interest rate for the first 12 months, which then drops automatically. Complex terms, accounts that only pay the advertised AER if you meet certain conditions, like making no withdrawals. And then of course there's fees and penalties. Some accounts deduct fees, which can eat into your returns without you even noticing. And so to tackle those traps, here's a couple of tips. Always read the small print, check the AER, but also look for hidden fees or restrictive terms that might affect your savings. To maximize the amount of money you're making via AER via your savings account, look for accounts with consistent high AERs, not just those offering promotional rates for a short period of time. And yes, you might not get the top of the top at the time you're looking, but at least you're getting something near the top, and at least you're reasonably confident that you won't get stung when any promotional term expires. And consider fixed term savings accounts. These can offer higher rates if you're willing to lock away your money for a long period of time. And of course, regularly review the savings accounts you've got to ensure you're getting competitive rates. I review mine at least annually. AER is one of the most important numbers to understand when you're comparing savings accounts. It cuts through the noise and gives you the real picture of your savings potential growth. It's a really clever number, really. And you know what else is clever? YouTube. It's picked out this next video especially for you. I can't even intro it because it will show different videos to different people, but I'm sure you'll love it. I'll see you there, wherever there is